I will be talking about the three stocks that I think will be performing the best in 2025. So, these three companies have really solid growth potential. Their stocks are at really good prices at the moment. And I really just think that they'll be outperforming significantly in the next few months. So, if you're interested, make sure to subscribe and let's get into it. So, the first company I want to talk about is Red Cat Holdings. This is a drone making company that does a lot of contracts for the US military. And I think there is a ton of potential here for them, whether that's international expansion or just expansion within the US military. So, looking at their stock recently, they hit a high of around $15 a share. Since then, they've come down pretty aggressively following the kind of overall market drop that was happening over the past right around 2 months. And in doing that, they've reached a fairly fair price for them. So let's get into their financials. So, first of all, a little bit more specific information on the company. They use AI and things like storage services, data for the drone industry. And basically, they developed some of the most advanced small military drones in the world. So, some key statistics here: market cap is at around 500 million at the moment. Average target price is about $13, which is more than double what the current price is at $6 a share. And this company, something that's unique about it, this is one of the highest growth summaries I've ever seen on FactSet. So the 10-year CAGR for their sales, which means per year percentage sales growth, is 115%. Um, EBITDA, EBIT are both really, really high as well. Their free cash flow estimates are also very high. So overall, I think this company is projected to have a ton of growth. And saying that, let's also get into their last earnings report. Now, I do have a recent video out on this company, which you can find in the description below to get more just general information. But there's a few things that I just want to talk about for this. So, first of all, some operation highlights. New winner of short U.S. Army's short range reconnaissance program. Strategic partnership with Palantir. This is going to be huge. They're developing AI for their drones in order to make them hopefully even better than they already are. Um, New leadership team as well. Hopefully that'll kind of lead them to the next era of their growth. New military contracts, a couple more things, new acquisition, tactical funding increase from the Air Force, and new manufacturing facility is going into operation fairly soon as well. So the company is really preparing for a lot of growth. And saying that, there's another thing I want to talk about is one indicator that I've been using over the past few months has been looking at the workforce growth of companies. And back when this company went public in 2021, they had around 14 employees. And since then, they have expanded to around 90. I'm sure that's higher now, with all the development that they've been going through recently. But they're currently right around 90 employees, up from 14 when they IPO'd. So that's another thing that I think can be very positive as well. Um, so just some highlights here as well. Black Widow drone is kind of their big product at the moment. Pleased to announce their partnership with Palantir again. AI and visual navigation. We believe the Black Widow is one of the most capable drones ever fielded by the Department of Defense. So overall, I think their technology is there to give them an advantage enough to where this company will see a lot of growth. And saying that, I want to get into the financials now and just go over a couple things that I think are very interesting. So, first off, their sales growth, if we exclude the 2024 estimates here, their sales growth over the past few years has been really impressive. Now, they are not close to profitability just yet. However, if we look at the estimates back on their snapshot page really quickly, we can see that their 2025 sales estimates are right around 100 million, which is 8 times higher than 2024's current sales. And if they can achieve this, which their next earnings report actually comes out later today, if they can achieve this kind of growth, I think it's going to be massive for the company. So if the sales manage to go up essentially 8 or 9 times like they're estimating, I would imagine this company will easily be in the billions. So right now they're at 500,000. or half a billion in market cap. I think if their sales go up that much, we can probably see them at 5 to 10 billion in market cap. Um, Again, in my opinion, make sure you all do all your own research on this. But overall, I just think the estimates look really solid going forward. So saying that, let's continue through the financials. So past couple years, they went from around 400,000 in revenue in 2020. And actually, if you just go back a little bit farther, before that, they had essentially no revenue. And now 5 years later, they have just about 18 million, just under 18 million in revenue. And that's expected to go to over 100 million in 2025. So, although they are not really close to being profitable, one thing to say is that their operating income did see a major improvement year over year, from 2023 to 2024, where they had a lot less of a loss. Same thing with their net income. So their sales are starting to kick into where they are kind of making up for some of those losses that they're having. But next thing, they don't have a lot of debt. So if we look here, their current short-term debt for 2024 is around a billion, and their long-term is 1.3 billion. Meanwhile, they have 6 billion, or sorry, this is all in millions. They currently have around 2.3 million total in debt. Meanwhile, they have 6 million in cash. So that puts them at a very healthy position to where they can very easily cover any debt they have. And also, it shows just how valuable their assets are, where their market cap is at half a billion. Meanwhile, their total assets is only around 48 million. So I think it kind of shows how much value there is with the company at the moment. And saying that, let's keep going forward through the cash flows. So, one thing we will see here, I believe, will be, it looks like they don't have the acquisition listed on here directly, but they did just recently, as we saw the earnings report, have an acquisition, which I think will just help them even more in the future. But looking through their cash flows, you're going to see a lot of negatives here. And one thing I will say about this is that it's to be expected when companies are developing as aggressively as this one is. So most of these numbers are perfectly fine. One thing I will say is that they are selling off a lot of their stock in order to continue to fund their operations. And while that is fairly bad, I don't think they've done it enough to where it will be a super major problem for them in the future. Also, you can see that they've been using some of that money to reduce their debt as well. So overall, I think it's not a terrible thing for them. One last thing going into the ratios, we won't really get too much information out of this just because they're not exactly profitable yet. One thing I do just want to highlight is that their SGA to sales is on the lower end of what they've been seeing since they've gone public. I believe in 2020 they went public, and they've seen much higher SG&As before that. So seeing it just about at 118% is kind of a breath of fresh air, especially compared to the year before where they were over 400%. So we are seeing improvements from that as well. And one last thing, their debt to equity, which we were just talking about, is very, very low at 5%. Usually, most companies have this right around 50 to 100%. So seeing them at 5% is perfectly fine. They're in an excellent position with that. And one thing I was saying with them issuing a lot of their own stock and selling some of their equity earlier is that while they are doing that, they also have a ton of room to take out more debt as well if they need to. So if the issuing of equity becomes a problem, they can always issue debt as well. And they have a ton of room to do that just based on how little of their debt to equity ratio really is. So saying that, that's my review of Red Cat. Next up, we have First Solar. So First Solar is a solar company. They've seen a bit of a rough time with their stock price over the past couple months, but what I'm seeing this as is a great buying opportunity for the company. So they are basically trading at a fairly steep discount from where they were over the past roughly 2 years. And this is another kind of situation where I want to talk about workforce. So they have been decreasing their workforce actually since before 2022. They were cutting jobs, lowering the size of their company. And in 2022, about halfway through, their stock price kind of rebounded and has been on an uptrend since then. And in doing that, we're seeing enormous growth in their workforce with double-digit percentage growth every single year. And the way I'm seeing this is that they are preparing for a huge expansion in their company, especially over the last 3 years. And saying that, let's get into a little bit more. So, first of all, they do design, manufacture, and sale of solar modules. So this company is just all about solar panels, solar energy. Um, Maybe you can get that from the name. But anyway, market cap is right around just under 14 billion actually at the moment. They IPO'd back in 2006, so they have been around for a long time. Target price is at 240 at the moment, which right now we're at 130, so they are significantly discounted from where the target is. Also, they have a positive long-term growth rate of 17%. Also, for their FactSet growth summary, the one thing I will say here is that while the sales numbers aren't very high, they are short term, and every single other number they have is fairly high, like their EBITDA growth at a 10% 10-year or 11% 10-year CAGR. That is fairly good. And either way, these numbers are positive, and that's really what you want to see for any company. So, saying that, next thing, sales estimates. So for 2025, they're expecting more than $1 billion higher than 2024. You could see their sales growth over the past few years. So back in 2019, 2020, they were kind of struggling. Their sales were going down. And since then, they have seen a fairly significant rebound with their sales expecting to be at 5.4 billion by the end of 2025. And you can see that in the stock price. So when their sales were struggling a bit more, they were down. And since they've been seeing a lot more increased growth, they are going much higher. And with the estimates in 2025, I'm expecting it to just continue to go that direction. So, saying that, let's get into their most recent earnings and talk about some things that I've been seeing. So, we will start with the results and guidance. So, a big thing for them is, of course, their guidance. And looking at the management comments here, we continued building the foundations for long term growth. We maintained a highly selective approach to bookings. We expanded manufacturing capacity with a new facility and construction of another new facility. And they're basically establishing the infrastructure to accelerate things, including a new research and development center in Ohio. And they produced and shipped a historic volume of modules. So I'm not going to read through everything that's showing here just because it'll take a little while. But there is a lot of positive things that I'm expecting to see from the company. 2025 guidance is showing 5.3 to 5.8 billion. So even a lot higher than that 5.4 that we saw in the estimates just a minute ago. But gross margin will be right around half of that. So a 50% margin is really solid, especially for a company like this, where it's in a developing industry that might not be the most mature. Operating income as well will be fairly positive. They're expecting earnings per diluted share of 17 to 20. Now, let's get into that a little bit more with the financials because that seems very high to me, but I also haven't gone over this company in a couple weeks. So let's get into everything. So, first of all, we already saw the sales growth. Gross income is accelerating rapidly as well. So you could see about a decade ago, actually, they were at much higher numbers, but since then they've kind of fallen off massively. And in the past just 2 or 3 years, they have seen an enormous amount of growth just in the profitability of the company, including operating income, which has gone aggressively positive over the past 2 years. They're now seeing $1.5 billion in operating profit. And saying that, they're also seeing a net profit, which for this company, they haven't seen it too often in the past, kind of on again, off again with being profitable. But seeing that they are now over $1 billion profitable, I think that is a very good sign for the future of the company. And these kind of multiples, especially for a technology like this, I feel like will result in them having a much higher valuation. We've seen companies with less sales and less total profit have much higher valuations. So the fact that this one is so low, I think puts them in a very undervalued situation. And saying that, also their EPS is very high just in general. So eight 2 years ago and 12 in 2024. So being at 17 in 2025 would kind of make sense. And saying that, let's look at the PE ratio of the company. So PE ratio is 14 currently, which is very low compared to where the market is currently. So they're currently at 14. Next year, they're expected to be at around 7. If they get a 7.1 PE ratio, I would be shocked. But also that would mean that they are so aggressively undervalued that it's almost a guaranteed buy just based on how stable the company is financially. They've been operating publicly since 2006, so you know they're in it for the long term, even despite being a much riskier industry like solar power. Let's keep going through the financials though. So looking in here at your balance sheet, 1.8 billion in cash currently, and their total debt, if we look here, is 250 for short term and just under 500 million for long term. So once again, they have a lot more cash than their current debt, putting them at a very flexible position to kind of do whatever they need to do in those cash heavy situations. Also, their assets overall have been blowing up over the past few years. They now have 12 billion in assets, coming up from right around an average of 6 to 7 billion basically over the entire past decade. So you can see that their growth plans are really kind of coming into fruition here with the way they've been accelerating how many assets they have. And a lot of times companies will kind of inflate their total assets by taking out a ton of cash or debt or selling off a bunch of equity to get cash. And it'll show a ton of asset growth, but almost all of it is cash. For this company, that is not the case at all. We're seeing a huge increase in property, plant, and equipment. There's also a ton of growth in receivables as well, which is basically just money that they're going to be receiving in the future. So saying that, I think they're in a much more promising position than some other companies that you might see having a lot of asset growth. But for them, it's not just gaining a bunch more cash, it's actually expanding the core foundation of the company. So anyway, moving into the cash flows, you could see a huge all-time high, actually not an all-time high in their cash flows. But one thing to point out with this is that while they have had higher operating cash flow in the past, they're also negative in that same year. So they had negative net income. Now they have positive net income. So these cash flows are actually coming from fairly good places, which is a lot better in my opinion. You can see they have been kind of mixed with purchasing and selling investments, so nothing to really say too much there. They have been issuing debt consistently every year, but again, we saw their debt situation is nothing to really be concerned about because of how much cash they have. That's perfectly fine. And their free cash flow has been very negative, but I'm expecting that to probably go more to the positive side within the next few years, possibly even couple quarters based on how much growth they're expecting in 2025. So either way, I think it will be a very positive thing in the future. Looking into their ratios now. So first of all, their gross margin is one of the highest they've ever seen. Actually, by far the highest they've ever seen. Operating margin at 35, again, highest they've ever seen. And saying these numbers, massive year over year improvements. If we look farther back, huge improvements across the board. And especially compared to 2023, where we look here towards the end of 2024, where we're really seeing those good numbers come in, their stock price is down. So just in my opinion, like we're lower than the entire year of 2023 at the moment. And that is with worse numbers and less sales. So the way I'm seeing that is they have a lot more value added to the company now to where their stock price can definitely go a lot higher than what we've seen in 2023, where they were higher than they are now, but we're seeing the results that will take them even higher than that. So anyway, net margin also 30%, up 5% year over year, which is amazing growth for any company in any industry. Especially just having a margin of 30% in an industry like solar, where, in my opinion, it doesn't seem like it would be very profitable, but it just has been for them. So, other than that, we don't have too much to go over other than just talking about the debt to equity, which again is at 9%. Like I was saying earlier with Red Cat, most companies are at the very least around 50%, possibly upwards of 100, depending on what kind of industry they are. But they have a very, very low debt to equity of 9%. That is extremely healthy. So in my opinion, it makes them a very good candidate for a ton of future growth, a ton of potential with their stock price. And I'm expecting them to have a lot of just appreciation over the next couple months. So anyway, on to the next company. Last company we're looking into today is Affirm Holdings. They are a commerce digital platform company. They basically make commerce commercial solutions for a lot of different types of companies. One thing I'm going to say is that they are in a very similar situation to companies sort of like Robinhood, where if you look at their stock price, I'll just bring it up here quick as an example. After their IPO, they saw a very long period of the price being very deflated and kind of seeing a big comeback, especially with Robinhood over the past few months. But I believe Affirm is doing a very similar thing at the moment. So you could see after their IPO, they had a lot of volatility with the stock price going all the way up to $170 a share. Currently, they're at 52, but in between there, they had about 2 or 3 years where the price just wasn't really anything to be optimistic about, other than maybe at the very end of 2023, they saw a really good run, but that was followed by a very steady sell off. So, saying that, I think there's a lot more potential now. You can see there is a upwards channel forming at the moment with the high point right around $80 to $90 a share and the bottom part right around 40 to 50 a share, which right now we are at the lower 50s. I'm expecting that to go back up to the top of that channel. So for a shorter term play, I think this is very good. But also for a longer term investment, I think they're also looking very good. So some things to look into, first of all, is these industry metrics they have. Active customers over the next year is expected to go from 18.6 million to 21.7 million. Huge growth there. Their take rate is increasing, which I believe is basically just how much money or something very similar to that they get from each interaction with their customers. Gross merchandise volume is going to go from 26.6 to 35.1, massive increase. Transaction expenses are expected to increase a little bit as well, but I don't think it will be as much as some of those other numbers. And other than that, there's just some loan details as well. So looking at the company, $16.8 billion market cap. They IPO'd back in 2021. So a fairly rough time to IPO, but it seems like they're performing well, even despite that. Target price at $75 and a very high long-term growth rate of 36%. So right now we're at $52. So there is a lot of upside there, about 50% from that target price. Looking into their growth summary. Now, we don't have the most information here, but the information that we do have is very positive, very highly positive, especially. So 54% sales CAGR over the next 5 years is awesome. Hopefully they can achieve that. I think they can. Let's get into their earnings and see what kind of highlights we can pick out here as just a couple key points of why the company I think is going to do very well. So let's look at the metric recap first and we'll go from there. So there's a ton of things to look into here. So total revenue looks like they beat on almost everything other than their interest income, but it looks like everything else made up for that significantly, beating by over 10 million in their merchant network. Servicing income also fell a little short, but also their gain on loans came in well above of estimates as well. Um, Total cost came in basically exactly in line with what they expected as well. So seeing their revenue beating, but their total cost coming essentially perfectly in line is a really good sign as well, showing a lot more profitability. And we're seeing that here. Operating margin was 27% compared to estimates of 22.4% and guidance of 21 to 23%. So a massive beat there. Also, some customer numbers, which again, huge increases. Total transactions up 45% year over year. Active customers up almost 20%. Transactions per customer up 20%. Active merchants again 20%. So just seeing enormous year over year growth for the company, which in my opinion, especially with the stock price currently being down over the past just about 2 months, I think that is a huge opportunity to kind of get in while the numbers are good, but the stock price just isn't where it should be. So saying that, I think that gives a pretty good opportunity. Other than that, let's look at, hopefully we have some management comments. No, we don't. Let's keep going through here. Reports. Let's try this one. So all of these almost always change. What we do have is guidance. So reports for quarter 2 of around 80 million versus a year ago of negative 160 million, which is pretty rough. Revenue is going to be outpacing at around 866 million. Operating income, again, massive beat. Quarter 3 guidance shows revenue right under 800 million. So a little bit of a quarter over quarter decrease. Nothing too crazy there, though. That could also be a seasonality thing as well, but they are roughly coming in line with the estimates. And then they also have quarter 4 guidance of getting back over that 800 million mark with a ton more GMV, which I'm going to be honest, I don't know what GMV means, but a lot higher of a number in quarter four. And then that operating margin is also expected to be a lot higher as well. So, saying all that, let's get into the specific financials of the company, and I'll kind of show you where I've been seeing a lot of growth for them. So, first of all, their sales have been consistently and honestly massively increasing over the past few years. So this column here is the full fiscal year 2024. That's what we're going to be focusing on. So 2.3 billion up from 1.5 a year before, and just a couple of years ago they were well under 1 billion. So seeing that they're almost at according to the last 12-month estimates of their last quarterly report, they'll be at just under 3 billion fairly soon. So that's pretty solid. Another thing to note is that SG&A expenses actually dropped year over year despite huge increases in sales. Cost of goods sold also very slightly increased compared to huge increases in sales. So overall, I think we're seeing a ton of operational efficiency happening here. Their operating income was very, very close to being positive over the past year as well, just losing about 82 million compared to almost actually well above 800 million the last year. So huge improvements there. Net income is still very negative. They lost $500 million in their net income last year. However, that is a massive improvement from losing almost a full billion the year before. And I think just seeing all of these improvements and the stock price still, as we saw, being down currently. So they are up from where we saw them back in 2023, but I think the improvements are enough to where it warrants them having a much higher valuation than they do now. And I just expect it to continue to outperform, especially with the further estimates they're giving. So we saw that with that year over year growth from 2024, they went from being right around 10 to maybe $25 a share to now they're right around $50 a share. If they continue that growth and the pattern stays the same, we could see them probably get all the way up to that 80 to 90 range fairly soon. As long as investors start taking a lot more interest, I think they have a ton more confidence now with their performance that they've been seeing. But anyway, let's finish off these financials so we could end the video fairly soon. 2.1 billion in cash, which is fairly solid. However, they do have a lot of long-term debt, just to be aware of that. Currently at 6.4 billion in total debt compared to that 2 billion in cash. However, I don't think that is the worst multiple ever, but even still, their debt is definitely an issue for them. So that will probably cause some unneeded expenses in the future. But again, they're using all of that to drive a lot more growth. They're seeing a lot more progress happening. So I really think that it will pay off and it won't be a problem in the future. They are also seeing, again, not really including too much in cash. They've seen a ton of asset growth over the past few years, and most of that is in long-term investments, which is a really good thing to have growing. That'll have a lot of positives for the future of the company, gives them a lot more flexibility if they need to sell off those in the future and get more money from them. So that is something to also think about. But anyway, we're going to keep moving through just to the ratios here. And looking at the ratios, let's get up to the top here if we can. There we go. So gross margin is roughly in the same range it has been in for a while now. The real improvements here that I want to talk about are in the SG&A expenses, where we saw a huge decrease from 136% to 88% in 2024. Operating margin went from negative 52 to only negative 3.5, and net margin went from negative 62 to negative 22. So while they are still losing money, I think we're going to see them, based on what the trend is kind of showing, we'll see them become net positive or profitable within probably 1 or 2 years. I don't know their exact timeline for that, but from what I'm seeing, it will most likely happen just within a couple years. And when that does happen, we're going to see the stock price appreciate massively. And I think that's definitely something that wouldn't want to be missed by most people. So I'll be in it. That's all I've got for today. One thing I do want to point out is that I do personally hold all of these stocks. I post my own portfolio roughly every single week, where I go over all of my own holdings. Um, Ensure you do all of your own research for all of these companies. I am not licensed financially or anything like that. So do all your own research. Do not invest in anything that just because I said it. So I think that's about it. That's all I got to cover. Thanks everyone so much for watching. Make sure to subscribe if you enjoyed. And I'll see everybody in the next one.